Liquidity is probably one of the most important topics or concepts that we need to fully understand when we're looking at trading, regardless of the strategy that we are trading. The more that you understand liquidity, the more that you understand where price is likely to go after it sweeps liquidity, after it builds liquidity, gives you a better edge on making better trade decisions. Whether those trade decisions are entering trades, managing trades, choosing target profits, or choosing simply not to enter trades at specific areas, liquidity can be incredibly helpful to understand how to position yourself properly when you're trading. When it comes to trading our particular strategy, we can use liquidity in a numerous amount of ways. One, to validate potential supply and demand areas. Two, look for targets. Three, look for areas that price is willing to go, which could allow a little bit of flexibility within your supply and demand zones, as well as understanding order flow on the lower time frames, as well as on the higher time frames. Because if we have an edge to understand where price is likely to travel to based on where we are in current price action, it gives us a better idea to know whether or not our trade idea is going to be solid or if we're going to have difficulties along the way. Especially if we're seeing, for instance, a trade being executed and we see price getting incredibly choppy, we are able to understand what price is doing or what price might be suggesting it's going to do for future reasons, because more often than not, price is making and creating liquidity for future reasons to tap into later. Liquidity is the gas of the market. We tap into these particular areas of liquidity onto the charts in order to fuel moves for future price movements and to seek that liquidity to then push price to a completely different area. When we look at a chart, we can see that at its core level, the market is moving from one point of liquidity to another point of liquidity. So here we have a very brief markup of the various different key elements of liquidity. There are different aspects of liquidity that I haven't mentioned here, but these are, in my opinion, the most common or the most important forms of liquidity. So the first ones we have are the equal highs and equal lows. This is something that we've spoken about in the content for quite some time. This is where you get either completely equal or relatively equal highs. And basically what this is showcasing is that there is, for a bearish setup, there is a bunch of buy side liquidity, so buy stop orders that rest above these highs. Now there's a couple different reasons why this occurs. One, a conventional trading strategy that I'm sure that we've all traded at one point or another in our trading career is a simple double top. So basically what we were trading at the time is if we got a swing high and we're starting to see a trend slow down, normally at an area of resistance, for instance, we'd be expecting that this secondary top would confirm that we are beginning to reverse and moving to the downside. Alternatively, with double bottoms, we would have two lows, and then that would signify that price is reversing to the upside. And in most cases, it does for a short period of time. But what we later find out and see in the market, that price runs on the liquidity to take the buy side liquidity, to take the sell side liquidity. So if we're looking at a double top, we know that there are buy stops that rest above these equal highs. The buy stops are two things. Anyone who's looking to sell or has sold at these areas will have their stop loss just above these highs. It's a common practice that we see in trading. And their sell orders would be here, which would mean that they would have a buy stop order as their stop loss just above these highs. So if price travels up here, it triggers their buy stop, closes them out of the position, liquidates them at a loss. On the flip side, we also have breakout traders and break and retest traders. If we were simply trading a breakout, you would have a buy stop just above these highs so that when price moves to the upside, it triggers their buy stop, getting them into the trade and looking to take that long. And then finally, what we have is we have break and retest traders, where we would look to break, retest, and then continue, which is why when we see equal highs, for instance, we get basically formations that look like this, because then what this is doing is it's taking the buy side liquidity and it's taking the newly created liquidity by the break and retest traders as well. And it's on the flip side as well for the sell side liquidity, that we would have sell stops right here, as many people would be looking to enter buys here. This would be their protective stop loss. And again, we would have breakout traders who would have sell stops to trigger them into the markets once price breaks those lows, or again, the break and retest traders. And what we more than often see is something like that takes sell side liquidity and then takes the newly created liquidity. Now we can take a look at momentum shift swing highs and momentum shift swing lows, which is really a combination of trendline mitigation and equal highs, because they can kind of come in all the same flavors. Initially, when trendline mitigation is being created, if I just drew a line here, what this ends up being is momentum shift swing highs. And if we get equal highs or relatively equal highs, this is basically what it's creating. This is kind of bridging the gap from equal highs to relatively equal highs, momentum shift highs, and then to the actual trend line mitigation highs. And again, equal lows to the momentum shift swing lows, and then to the trend line mitigation. So what this signifies is that we're creating a series of, in this case, lower highs, and then we're starting to put in lower lows. So what this is doing is creating liquidity for future price movements to return back to, and what we'll often see is price gravitate back to this after we've broken some sort of major swing low. Same thing with the momentum shift swing lows, is once we've created these higher lows, at some point price is gravitating back towards them. Why? Because anyone who is looking to buy, whether it was on a demand zone, whether it was just on simply a break and retest of more of the origin, we could even look at a Fibonacci and see that this is a 61.8 or 786 Fibonacci level that many traders will look to be buying at. Stop losses would be just above swing highs or just below swing lows. So as we know, price is more than likely going to gravitate to these liquidity areas in the future. And that's one thing that we need to understand when we're looking at these patterns, is just because we see equal highs, just because we see momentum shift highs, does not mean that price is just going to automatically run them immediately. What it means is it's an area of interest for future price to consider. We need to ask ourselves, why were these equal highs formed? Why were these relatively equal highs formed? Why were these relatively equal lows formed? Why were these momentum shift lows formed? What is that telling me for future price action? What is that likely going to cause in the future? Because at the end of the day, what needs to happen when price is moving to the downside, per se, is we need to create liquidity so that when price does come back to the upside, we have areas of liquidity to tap back into to then keep pushing price to the upside, or take the orders and then begin to reverse to the downside. And then we can look at the more evolved version, the trendline / mitigation liquidity. And basically what this is it's a combination of these momentum shift swing highs in succession. We can even look at it as almost form of descending channels, because we do see often price doing this. And what we can also see from what we've seen in the past too, we get a spike to the upside and continue. But again, similar to momentum shift highs and momentum shift lows, this is also future liquidity to be tapped into, because if price just keeps moving to the downside, at some point we're going to move to the upside and clear all of the liquidity. And what we can also look at within it when we're looking at order flow, if we start to see a series of supply zones being created and tapped into, this is essentially institutions moving the money. So when they're taking their large sell orders, they're also taking buys, which is why we get buy to sell type price action. So once price moves down here, their buy orders are in quite a bit of drawdown. And then once price gravitates back towards the origin point or their entry point, they close the buys, load up on more sells, and more often than not can also enter more buys. Price moves to the downside, comes back up and mitigates. And this could just keep happening for quite some time until we've created a ton of liquidity, and then you'll just see price explode to the upside. If you need a little bit more clarification on the mitigation process, I do highly recommend the mitigation video that was dropped as well, just to expand upon this theory. And the same can be said for trendline mitigation. On the bullish side, we start to see demand zones being created. Institutions are taking sell and buy trades. The buys are the key trades or the main trades that they're taking, but the sells are also facilitated. That's why we tend to get sell to buy price action. The sells would be in drawdown until they reach back to the original entry, where they close the sells at a break even or slight loss, or maybe slight profit. But either way, it's about effectively mitigating the risk on the sells and loading up on more buys. What we might also see is more sells being brought in, more sell to buy price action. Again, we mitigate down, close sells, and basically moving the money as price continues. But then what we can see, similar to the above example, is we can just see this continuing, and then at some point we can see that liquidity get run. And then the final bit of liquidity, or key areas of liquidity to keep in mind, are range bound liquidity. And basically what this is almost the same as equal highs and equal lows. But what we can see is price comes from an impulse to the downside, and then we start to create equal highs, equal lows. Now the range itself can be much longer. We can see price basically do stuff like this: sweep the highs, sweep the lows, and then just start to make bigger ranges. I'm sure we've all seen it time and time again until we initiate out. And what this suggests is that we're building liquidity on either side, and the side that does not get initiated out of. So in this case, we've initiated to the downside. there's liquidity resting above here that is more than likely in the future going to be pooled at some stage or another. Same thing with the bullish example. We can see that we create equal highs, we create equal lows. We do end up breaking the equal highs, taking the buy side liquidity, but the sell side liquidity still remains. And at some point in the future, we can see price return back to this area to sweep that liquidity and continue, or even just use that to break through, take all of the sell side liquidity and then continue to the downside. Because one thing to keep in mind when it comes to liquidity, we don't know whether price is just targeting this area to then reverse, or it's targeting that area to continue. At the end of the day, liquidity is fuel and the market is going to use it as it sees fit. And this is when we start to combine market structure and we start to combine supply and demand zones. We know that price moves from one zone to another zone, and we're using liquidity as fuel to move price up and down from zone to zone. It creates it for future reasons and consumes previous amounts of liquidity. So now let's look into the charts. Let's look at some examples and basically just walk through some price action. I've already taken some time to mark up pound US dollar here on the hourly chart, just to kind of explain what we're seeing and give a overall consensus or idea of how price is moving from zone to zone and using future liquidity to target those areas. Now we'll start just on the left here. And as we can see, price is caught in an otherwise sideways range. We initiate out of that range, and then price begins to basically create a larger range. So we can all gain the understanding that here on the hourly chart, pound US dollar is in a range for the most part. What this gives us is we're able to understand range bound liquidity. We know that there is liquidity resting above here. We can also see that even just without referencing the range, we can just see this series of equal highs. If we look into the range a little bit clearer as well, what we can see is we created a supply zone. We've tapped into that supply zone. We have trend line liquidity, or we have momentum shift liquidity. We have a swing low here, a swing low here. What does that end up doing? We see that price comes and breaks to the downside. Then we create a range. We come and we move to the upside, taking this. So we know that this is something to keep in mind for the future. Then what do we see? Let's keep that there. We see that we have equal highs here. That was part of this mitigation of this supply zone. And we can see as we sweep that liquidity, we also create a range in price right here. We also have equal highs. So we've swept that bit of price action as well. We've also, if I just clear up some of this as well, just to dig into liquidity just a little bit more, clear that up. We can see that we have trendline liquidity. We have these swing high, swing high, swing high, these equal highs. So we know that there's liquidity resting above all of this area, and even just more specifically, these highs right here. So we have liquidity resting just above these highs right here. And then if we just look, price has tapped into the liquidity of that with this candle that swept all of that liquidity as well. And then that's when we see a true initiation down into the lower price action. Now, if we look, we have this range right here. We've broken to the downside. So we have liquidity that's resting above here. We create a range just like this. We break to the downside. We know that we have liquidity resting just above here. Noticed a newly established supply zone. We've initiated out. And then if we continue moving on, we can see that we have equal highs, equal lows. We have this overall range. So we know that we have liquidity. And what we can see is we break out of that range. We build some trendline liquidity. We break to the downside. We tap into this demand zone. And what we can see as we're creating that, we're creating more trendline mitigation liquidity, because as we can see, we have a demand zone that gets tapped into. We break this structure just barely. We create a demand zone here. We tap into it. We run away. Here's another mitigation. And what we can see, if we just draw a trendline / mitigation liquidity, we then come down and tap into this demand zone, which is yet to be tapped into. As we can see, price just missed it right here. We have a little bit of imbalance. As we can see, when price comes up to the supply zone, we're starting to create all of this really corrective price action, this really wicky and efficient price action that's dropping these very significant swing lows with these wicks. What does that give us? That gives us cause for lower prices. What we can see is that cause is what brings us into this demand zone, which then creates and solidifies this trend line / mitigation liquidity. Then what we can see is we create a range right here. We have equal highs as well. We break to the downside. We create more equal lows right here. We create a little range here as well. We break to the downside, so we've cleared liquidity. So we have liquidity here. We have liquidity here. And then we just keep falling price. We've tapped into this demand zone. We've taken all of the liquidity that rests here. So basically all of this range here has been effectively mitigated in terms of liquidity. There's really no liquidity that's resting within this range. We know that we have liquidity resting down here for future potential reasons. We can also start to gain that we're starting to build some sort of trendline liquidity for a larger move to the downside as well. Then if we keep moving to the right, we have range bound liquidity. We sweep to the upside, then we sweep to the downside as well. And if we also draw in a demand zone from all of these candles, we can see that price taps into this area and we mitigate. So what does that give us? As I had drawn from this point, we also have trendline liquidity that can be tapped into as well. We have equal highs here as well. We tap in, we sweep that liquidity and move to the upside. Now we're developing equal highs as well. We have a demand zone here, which we're not quite tapped into yet. We could see price move to the downside, build equal lows, then tap in and then continue. Why? Because we have a ton of liquidity right there that's resting there. And it's really about just understanding these small nuances, these small bits of liquidity ranges. It's not going to be clear. It's not going to be easy initially, but once you can start to really understand what's happening on the charts, the liquidity that's being created, things become much more clear. We can see that we have equal lows right here. They get swept. Again, we can really just start drawing ranges. We can draw liquidity. And this is something that I highly recommend everyone do when they're trying to understand liquidity. Initially, all these concepts might go over your head. They might seem confusing. They might seem a little abstract. It might give the interpretation that, I cherry picked this range. I've literally just plotted all this out prior to starting this video just to have something to work with. But then as you can see, the logic is all there if we're willing to actually read it and understand it and really just break it down. We can see that price just moves from range to range, creates a bunch of ranges. And this is why ranges become very key. And it's also about asking ourselves, where are ranges being created and does the range make sense to trade? Because often what we have been saying a lot in the content recently, the commentaries, things like that, and within the community is that ranges are an area where fair value is being offered, or at least that there are a large amount of transactions transacting. Price isn't really moving up or down because there's a lot of buying and selling going on. And what that generally implies is that institutions are loading up on positions, or there is at least a large volume of transactions that are occurring. But we need to ask ourselves, when we see ranges, when we see a particular range and we're considering the price action within it, if we were looking at this range, for instance, we see this impulse out, range, impulse out. This would look like a good area to sell, but we also know that we have a supply zone up here and we have a lot more imbalance right here as well. We have some equal highs, maybe not as clear. We have equal highs here that get swept, equal lows. But overall in this range, we have liquidity that would be resting above here, because if you're looking at it from a conventional sense, I used to trade ranges when I scalped, and basically what you would do, and it kind of makes me cringe when I think about it now, but you draw a box. It was called the box and chill method. Basically, you would draw a box around consolidating price action. You'd put a buy limit with a stop loss just below, and you put a sell limit with a stop just above. So regardless of which way the market broke, you would get triggered into a trade. Now, I can see it perfectly with this. What happened more often than not, price would break out to the downside. You get triggered in for the sell. You'd have, your range would be here. You'd get triggered into the buy, so you'd lose both times and get totally destroyed by the markets. Again, makes me cringe just thinking about it, but really understanding how a lot of traders trade, especially when you correlate that with the Asian session, which is what this is right here. This is basically starts from 2 p.m. Eastern and doesn't end until basically the London Open when we initiate out of that range. So this is that Asian session. And a lot of these ranges do occur around the Asian session just because there's a lot lower volatility and volume that's being traded within the markets. But again, it's all about understanding liquidity, understanding the cause that's being created as prices, for instance, moving to the upside. What is this telling us? As we're pushing higher, we're starting to create significant swing lows. And regardless of how you're trading, some people like to trade some type of flag patterns, things like that. Where are they going to put their stops? They're going to put them just under there, even break-even points. You can even see that we have multiple small range liquidity that's within all of this. And what we can see is we have range liquidity here as well. We initiate out and then we initiate up. If I can draw that a little bit cleaner. We've taken the